Hello everyone, and welcome to today's TCFD Masterclass, demonstrating good practice in implementation. During this webinar, we will present the recently launched TCFD Good Practice Handbook, created by the Climate Disclosure Standards Board and the Sustainability Accounting Standards Board. The authors of the handbook today will share key insights and takeaways from the publication and illustrate what good practice disclosure looks like through real-world examples of TCFD-aligned disclosures in mainstream reports from across the G20. We encourage you all to participate in this webinar and submit your questions using the Q&A function on the right-hand side in your toolbar. We will dedicate time at the end of the presentation to discuss and answer your questions. Now, it is my pleasure to introduce you to our presenters. Nadine joined the Climate Disclosure Standards Board as Technical Director in 2017. Her work focuses on integrating climate and natural capital risks and opportunities into decision-making, legal and regulatory frameworks, and corporate reporting. Nadine leads CDSB's work as Technical Director, and she manages its expert technical working group and produces and delivers technical and advocacy materials. David is responsible for developing and managing SASB's research team's strategic plan, establishing and overseeing research projects and practice areas, and also managing internal interfaces between the research team and other departments. His role is centred on the identification, prioritisation and management of research projects that further SASB's mission to establish and maintain disclosure standards that facilitate communication by companies to investors of decision-useful information. My name is Leslie McKenna. I'm the Communications Manager here at CDSB, and I'll be your moderator for the day. Before we dive into the presentation, I would like you all to participate in the following poll. Is your organisation currently implementing the TCFD recommendations in the mainstream report? I will now make the poll live. So you should be able to see the poll on your screen, and you can select your answer using the poll function. So please do select either yes, no, or intend to do so in the next 3 years. The idea here is that at the end of the presentation, we will share and discuss the results, and we will also get feedback from both Nadine and David to assess their findings of the poll. I will allow just another 1 or 2, just another 30 seconds to collate the responses. Okay, thank you very much. Some very interesting results, and we do look forward to discussing those shortly. So now I will pass you over to our presenters, where Nadine will begin the presentation.
Thank you, Leslie. Good morning, good afternoon, good evening, everyone. Just to start off with a little bit about the Climate Disclosure Standards Board. We are a consortium of 9 environmental and business NGOs, including SASB, our partner on the webinar today. We were set up in Davos at the World Economic Forum in 2007 with a mission to create the enabling conditions for material climate change and natural capital information to be integrated into the mainstream report. And we achieve our mission by offering a framework for reporting environmental and climate information. And we're also supported by a technical working group of experts, and some of the examples here are listed on the slide. Now on the next slide, next slide, please. Before we delve into the TCFD Good Practices Handbook, I'd just like to take a moment to remind everyone of CDSB's framework for reporting climate and environmental information. So the framework consists of 7 principles and 12 requirements. So 7 guiding principles are how to report, and they're listed at the top. So they include things like connectivity with other information. And then the 12 reporting requirements are what to report. So there's specific requirements around governance, risks and opportunities, reporting period, assurance, etc. And they include what to report in the mainstream report. Now, the CDSB framework is fully aligned with the TCFD recommendations, and it's complementary to existing reporting provisions such as CDP, GRI, SASB, and other existing regulations. The CDSB framework has been referenced in the guidance to the EU's non-financial reporting directive and in a number of stock exchange guidance globally. Now, I will hand over to David, who will say a few words about the market-tested standards from SASB, which can also aid in implementation of the TCFD.
Great. Thank you so much, Nadine. And again, hello to everyone joining the webinar. So I'll just briefly introduce who SASB is as an organization. We are an independent, nonprofit standard-setting organization that sets disclosure standards that connect businesses and investors on the financial impacts of sustainability. And so we enable that through the establishment of our 77 industry-specific disclosure standards. And these standards each contain topics that are likely to be financially material in that given industry, and then for each topic, associated metrics that measure and communicate performance in a comparable and decision-useful way. Now, our standards are designed to be used by companies and by investors globally, really to enable that connection on financially material sustainability issues. On the next slide, I'll briefly review our approach to standard setting. When we began developing our standards in 2011, our goal was to create standards that facilitate the disclosure of financially material sustainability information, and to do so in a way that is decision useful and comparable for both companies and investors. And at the same time, we sought to ensure that the standards were cost effective for companies to implement. So in order to create standards with those 3 pillars in mind, we of course took an industry-specific approach, developing the 77 different industry standards, and ensured that our standards are informed both by market feedback as well as a sound basis in evidence. And with that, I will pass it back to, well, actually, I think I've got the next slide, so I'll just continue going. So to wrap up the introduction of the previous 2 organizations, now I just want to dive briefly into how SASB, the CDSB, and TCFD sit together. So the SASB standards are really there to help you with the content to support your disclosures by generating financially material data and information. The CDSB framework has a set of principles and requirements which Nadine shared in the slides that she presented. And those principles cover how to report, and the requirements cover what to report in your mainstream report. Now, both the SASB standards and the CDSB framework can be used as analytical tools to help make high-quality, comparable TCFD disclosures in the mainstream report. So next, we'll spend a bit of time diving into and reviewing the TCFD's recommendations themselves. And for that, I'll pass it back to Nadine to introduce the TCFD's recommendations.
Thank you, David. So to get started, we thought it might be useful for those of you who are a little bit less familiar with the TCFD, and to provide a recap for those of you who are about the TCFD. So the TCFD builds on existing frameworks and standards and other requirements. So it builds on things like the CDSB framework and the SASB standards, which David and I have mentioned. It's seen as a unifier, and for many, it is the gold standard for making universally applicable climate-related financial disclosures. Now, the TCFD has helped to galvanize political will and to bring climate-related financial disclosures into the mainstream and into the boardroom. So we have awareness with over 850 TCFD supporters, and we're seeing increased momentum in the number and extent of corporate disclosures. But we'd also like to see this go further and faster. And mandatory is one way, but it is important to also provide capacity building support and to recognize the evolving body of good practice climate disclosures. And that's specifically what we do in the Good Practices Handbook. So if we move on to the next slide, I'm just going to hand over to David, who's going to recap the 4 core elements of the TCFD.
Perfect. Thank you, Nadine. So I'll just briefly review what the TCFD's recommendations are. And as Nadine mentioned, they're broadly categorized under 4 key areas. That's the company's governance related to climate-related risks and opportunities, its strategy to address the climate-related risks and opportunities that impact its business. Third, its risk management process, for which the TCFD recommends that companies disclose how the organization identifies, assesses, and manages climate-related risks. And finally, the company's metrics and targets that it uses to assess and manage climate-related risks and opportunities. And so for governance, really, the recommendations are around how the company oversees climate-related risk and opportunities, both by the board and by management. For strategy, the recommendations relate to how the company accounts for these risks and opportunities, including the risks to which it is exposed, the impacts of those risks on the business, and finally, the organization's resilience to scenarios that are consistent with the 2-degree or lower pathway. For risk management, the recommendations are really focused on the company's process to identify, assess, and manage risks, and then how that is integrated into the organization's overall risk management process. And then finally, for metrics and targets, the recommended disclosures include a company's Scope 1, Scope 2, and, if appropriate, Scope 3 emissions, as well as other metrics and targets used by the organization to communicate its performance on climate-related risk. And now on the next slide, I'll go ahead and pass it back to Nadine.
Thank you, David. So why have SASB and CDSB come together a second time to look at supporting TCFD implementation in the forms of a good practice handbook? So as Michael Bloomberg so succinctly put it, progress must be accelerated. Today's disclosures remain far from the scale the market needs to channel investment to sustainable and resilient solutions, opportunities, and business models. I believe in the power of transparency to spur action on climate change through market forces. There is no doubt that we need to accelerate the adoption of the TCFD recommendations globally, and unprecedented changes are needed to meet the goals of the Paris Agreement. Given the complex nature of climate change, companies need to consider the financial risks and opportunities that climate change poses to their activity, strategy, and business. Similarly, investors need decision-useful information on how companies are prepared so that they can better understand their exposure to these risks and allocate capital accordingly to support long-term sustainable economic systems aligned with a 1.5-degree pathway. What are investors getting? What can we do more to move from paper to practice? How can we increase uptake of scale? How do we get better disclosures faster? Currently, only 4% of companies globally make 10 of the 11 recommended disclosures, and 3.6 of the 11 recommended disclosures are being made by organizations on average. So we have a way to go. We have this globally agreed framework, but companies are not using it as intended. Uptake at scale is urgently needed. So David, what exactly are investors asking for in terms of climate-related financial disclosures? And David, can you take us to the next slide, please?
Apologies. Yes, here I was on mute. So to follow up to your comment, we briefly surveyed members of our investor network to find out areas for which they were seeking disclosure in accordance with the TCFD's 4 recommendation areas. So I'll briefly touch on each of those 4 categories and share some of the insights that we heard in that survey from investors. So diving into governance, what we really heard was that there was a strong desire from investors for specificity and detail around the board-level oversight of climate risk, specifically including a clear description of the board-level responsibilities and relevant board member qualifications associated with climate risk evaluation. Additionally, we heard that the frequency and types of interactions with management around climate-related performance was useful data to investors. And finally, there was a strong desire to understand the use of targets to establish accountability around performance. Moving to strategy, some of the feedback we heard there was first, the value in having specific time horizons specified with respect to descriptions of the company's strategy to mitigate risks or to capture opportunities. In addition, we heard the desire for stronger and more clear connections to financial impacts, including company expenditures to achieve these strategies, as well as the long-term financial benefits resulting from them. And this really resonated with some of the results that the TCFD found themselves in their 2019 status report. Additionally, investors expressed a desire for more clarity around how companies assess the materiality of climate-related risks to their business, so the process by which they determined which risks really rose to the level of financial materiality. Moving to risk management, investors expressed a desire to have clear definitions of the categories and specific channels of risk the company has identified as material to its business. They also expressed a desire for greater clarity around the process by which companies prioritize risks and how that prioritization may change over time in response to actions taken by the company to mitigate the risks it has identified. And finally, there was an expression for more information around a company's risk management process and importantly for the connectivity of information, how that informs the board's decisions around the strategic resilience of the organization. And finally, for metrics and targets, one of the things we heard was that investors wanted to understand how the targets set by the company relate back to its strategy, and that they can track and understand a company's performance towards achieving the targets that are consistent with the strategy the company has laid out. There was also a expression that historical performance data was useful to give investors a sense of the trajectory the company is following. Additionally, investors identified the value in seeing the calculation, not seeing necessarily, but having insight into the calculation methodology by which metrics were reported, which is really important for having comparability. And then finally, there was a desire for more robust normalization factors, which really can help facilitate comparability across companies of different size or scale. And so based on what we heard, this really helped inform some of the guidance that SASB and the CDSB identified that we could provide to the market to help close some of these gaps. And for that, I'll pass it back to Nadine.
Thank you, David. On the next slide, we present the two twin tools for making TCFD-aligned disclosures. So as David said, we developed two set of tools to help build momentum and enhance the quality of climate-related financial disclosures at scale, and to ensure that the provision of decision-useful information to the market. So for a company that is looking at getting started, we recommend you start with the guide on the left of the slide, the TCFD Implementation Guide. It offers practical how-to guidance for companies on implementing the TCFD recommendations using mock disclosures. However, the purpose of today's webinar is to demonstrate what good practice looks like from leading companies globally in implementing the TCFD recommendations. When we developed the TCFD Good Practices Handbook, we felt there was and that there is value in learning from one's peers and how they have approached disclosures. So now if I hand back to David, he will introduce the handbook. Thank you.
Great. Thank you, Nadine. So as Nadine mentioned, this handbook really is intended to provide tangible, real-world examples of good practices in TCFD disclosure from mainstream reports. So in the following slides, we're going to dive into sort of a preview of the handbook using some examples from annual reports to highlight what good practice disclosure looks like. In the handbook, the examples are drawn from 19 different annual reports. And if you refer to the guide, you can see the list of companies on page 45, as well as the geographies and TCFD sectors covered. We covered both financial and non-financial sectors, including for the non-financial sectors, energy, materials and building and transportation, really trying to show the breadth of examples across different industry groups. Of course, there are other good examples of good practices emerging, which do not draw on examples from the annual report. And the reason we focus on the annual report is really the importance of the connectivity between financial and non-financial information as recommended by the TCFD and including this information in your mainstream report. So now let's go ahead and dive into the Good Practice Handbook and take a look at examples from each TCFD core element. We'll start with governance, and I'll pass back to Nadine to walk us through this first example.
Thank you, David. So there are 4 sections to the handbook, one for each of the core elements. So this first section of the handbook presents good practice disclosures regarding those individuals, business areas, and management and governance bodies within the business charged with responsibility for managing or overseeing climate-related risks and opportunities. We consider both the role of the board in overseeing climate-related issues and also management's role in assessing and managing climate-related issues as required under the 2 TCFD recommended disclosures for governance. So in this first example, we look at Canadian mining company Barrick. We like this example because it clearly states that the board has oversight of climate-related risks and opportunities. And it also explains the roles of the audit and board committees, which is something we don't see in a lot of disclosures. The second thing that this example does is it connects who is involved with how they manage such risks. For example, the risk committee assists the board in overseeing the company's management of enterprise risks. And we like that climate change is built into existing risk management processes, again, as advocated by the TCFD. Now, if we go on to the next slide, a second example of governance comes from the Royal Bank of Canada. There are 2 extracts here on the slide. The first good practice relates to board oversight and leadership. We particularly like that the board chair, in introducing the annual report, says that climate change is the most pressing issue of our age, a message that we have heard reinforced recently in Climate Week in New York. The chair then goes on to state the board's oversight function. The second extract at the bottom of the slide explains the different functions involved, and there's good practice in linking back to performance goals on climate change for management. Now, if I hand back to David, he will take us through some strategy examples.
Great, thanks Nadine. So we'll go ahead and jump into strategy, and we'll look first at an example from Danone. So generally in this section, we begin by identifying good practices of companies and disclosing how they have identified which climate-related issues are relevant and material to them, and then specify that relevance across different time horizons. Additionally, once a company has identified the climate issues that are likely to have a material impact on the company, we then have provided good practice examples where the company has fleshed out how these issues will impact their businesses, their strategies, and their financial planning in accordance with the TCFD's recommendations. So while the TCFD has identified these as separate recommended disclosures, it really became apparent to us as we reviewed disclosures that these 2 different recommended disclosures are often very closely intertwined. And on that note, we'll dive in here to this example from Danone, which brings this to life. So the disclosure excerpts here are interesting as they cover both climate and natural capital related factors, which shows how climate can be integrated and connected to other information in the mainstream report. So this example is particularly helpful in that it links the company's strategy to its risk management process, and specifically wider risk identification and management. It identifies both midterm risks and then connects those midterm risks to the implications for the business. So in the second disclosure excerpt here, we can see that Danone has identified physical climate risks, and then importantly, it explains the impacts of these risks on its activities, including its operations and supplier and stakeholder relationships. It then goes on to explain how these risks are addressed in its strategy. So as you can see, Danone has presented both a description of the climate risks it faces, as well as Danone's associated management measures to manage those risks. If we turn to the next example from strategy, this is an example from the French firm EDF, which is an a power utility. And there's a couple interesting things that I'd like to point out here from this disclosure excerpt. First, EDF has identified both the risks and the opportunities associated with climate change on its business. Specifically, it's providing an example of transition risks in the form of regulatory changes in France and in the European Union, as well as technological changes associated with an increasingly decentralized, low-carbon digital economy, which may lead to the emergence of new economic models associated with power generation and consumption. So then EDF follows up to the identification of each of these risks and opportunities and further details how they may impact the company's assets, its operations, its products and services, its value chain and suppliers, its financial planning and performance, its capital expense allocation, its access to capital, and other financial impacts. So this is very important in that it demonstrates the connectivity to financial impacts from the company's climate-related risk exposure as part of its overall strategy. And this is really something that investors have identified both in the survey that we reviewed earlier, as well as the TCFD's 2019 status report, as being a particularly important part of disclosure. And now I'll pass back to Nadine, who will walk us through an example of risk management.
Thank you, David. So the third section of the handbook offers good practice examples of TCFD risk management disclosures. And there's a particular focus on the processes for managing and determining the significance of climate-related risks. And we also look at how they're embedded into existing and wider risk management processes within the business. And in this section of the handbook, we also consider risk classification frameworks and definitions used when looking at examples. So if we look first at NE's annual report, on the slide in front of us, it shows that they have an existing risk management framework and they've adopted it, and climate risks are identified as a top strategic risks within this existing risk framework. This is consistent with the TCFD recommendation that existing processes for risk management and governance be used and adopted. In this example, there is also good practice of considering different time horizons. And there is good practice in that NE has considered both transition and physical risks and the processes and functions involved in managing these. This also illustrates the interconnectivity of TCFD disclosures across the 4 TCFD core elements. So if we go on to the next slide, we have a second example of risk management, which is drawn from HSBC. Like the previous example of NE, climate risks are considered in the context of existing risk management processes. In this example, HSBC goes on to explain how climate risk is considered in the context of credit risks. It also identifies six higher transition risks and their respective exposure to them. As in the last example, this shows the connectivity of TCFD disclosures. HSBC included climate risk in its board-approved risk management statement, illustrating the interrelationship between risk management and board oversight disclosures. If there's one key message to take away from this webinar, it is that TCFD disclosures should not be viewed in isolation or in silo. Finally, we also like the fact that HSBC is looking to expand its use of metrics and targets for the 6 higher transition risks it has identified and sees its disclosures as evolving over time. This is a perfect segue as I hand back to David, who will share some good practices we surfaced on the TCFD metrics and targets.
Great, thank you, Nadine. So we'll dive in now to metrics and targets. And the section for metrics and targets really focuses on providing examples that quantify the effectiveness of a company's strategic responses to climate-related risks and opportunities, and also provide sufficient qualitative context to facilitate the user's understanding of the financial implications of the reported performance metrics. And additionally, this section covers how companies can establish meaningful, measurable climate-related performance goals. So a great example of this here is from Prudential, a British multinational life insurance and financial services company. So I'll touch on a few key points from the disclosure excerpt from Prudential. First, they include a specific climate-related target. Here they specify that they plan to achieve 100% renewable energy by 2025. Now, there's 3 important traits to this target that are in accordance with the TCFD's guidance around disclosing targets. First, there is a specific and quantifiable outcome. In this case, they've set their target of achieving 100% renewable energy. Second, they include a base year from which progress is measured, here disclosing 2018 as their base year. And third, they include a target year by which the company expects to reach its goal, in this case, 2025. So while these seem fairly straightforward, it's interesting to note that in many cases across the disclosure examples that we reviewed, we didn't find all 3 of those elements associated with target setting. And again, those are a quantifiable outcome, a base year from which progress is measured, and a target year in which the company expects to reach its goal. Additionally, you can observe that Prudential includes a discussion of its progress against the target in the current reporting year, which is important in helping investors understand the effectiveness of its strategy in allowing it to accomplish its goal. And third, on the right-hand side of the slide, Prudential has included its Scope 1, Scope 2, and Scope 3 emissions, breaking them out both by occupied and investment real estate. Importantly, at the bottom of the table, you can see that it has reported normalized metrics, which can enhance the comparability of data reported across companies. Importantly, and again in accordance with the TCFD's recommendations, they include the normalization factor by which they have normalized their emissions, which again enhances the comparability of information. On the next slide, we'll look at another example from Metrics and Targets, and this time we'll look at Gold Fields, which is a South African mining company. Looking in the top left, you can see the figure that's shown there, and this includes the company's Scope 1, Scope 2, and Scope 3 emissions. The table is nice in that it allows you to see the distribution of its emissions across its direct and indirect emissions, as well as its aggregate emissions year over year. The company then goes on to discuss its progress in reducing its emissions year over year, and it specifically explains how it has accomplished this, in this case, through decreasing its energy usage or conversely increasing its energy efficiency. The company also provides a normalized metric reporting the tons of CO2 equivalent per ounce of gold produced, which again, as we saw in the Prudential example, can really enhance the comparability across companies that choose a similar normalization factor. Again, with the importance there of it disclosing the factor by which it's normalized its emissions. And finally, it has set an aspirational target with a base year of 2017 and a target year of 2020 to reduce its cumulative carbon emissions, and as with the previous example, reports its progress towards that target in the current reporting year. So now we've gone over just a few examples from the Good Practice Handbook of the 4 categories of the TCFD's recommendation areas. And I'd like to pass back to Nadine, who is going to walk us through some of the lessons we learned from producing the Good Practice Handbook for companies.
Thank you, David. On the sort of coming towards the end of the webinar, we just wanted to identify what we call 7 top tips for developing and refining climate-related disclosures. The first one is that we found in reviewing annual reports that some report preparers are confused by the orientation or lens for TCFD. So for TCFD, we're looking at the impact of climate on the business, not the converse. So that's the first tip we would recommend. The second one is about making holistic disclosures. So as we've demonstrated throughout this webinar, disclosures are often interconnected and mutually reinforcing. So ensuring the connectivity of information is key, and this includes linking financial and non-financial information. Thirdly, we found that there was often a muddling of the governance disclosures. So it's important to explain how the board exercises its oversight function of climate risks and opportunities, and also how this differs from managers' roles and responsibilities. So there's a distinction between climate leadership and management. Both are important, hence the 2 TCFD recommended disclosures. The fourth top tip is about explaining how you assess the material risks of climate change to your business. So we found that often the process for assessing materiality was absent from disclosures. Fifthly, we found that beyond Scope 1 and 2 emissions, climate-related financial disclosures differ from companies to company and within industries. However, there are existing standards and metrics that can be used to help you make your TCFD disclosures. So you may have most of what you need already in hand. Sixth, it's important to consider TCFD like a bunch of puzzle pieces that holistically help you to tell your story of how you're identifying, assessing, and managing climate-related risks and opportunities. So we recommend putting as many of the 11 recommended disclosures as you can in your or making as many of the recommended disclosures as you can. Finally, the recommendation of the TCFD is that you put your disclosures in your mainstream report. So the annual report is aimed principally at investors. This allows you to put climate-related information on the same level of rigor as financial information. It allows you to make key linkages between non-financial and financial information. And basically, if it's in the mainstream report, it matters. So overall, we are moving along the TCFD implementation path with more companies and disclosures. Let's keep going, learning by doing and refining our evolving practice. We say, don't let the perfect be the enemy of the good when making your climate-related financial disclosures. This is an evolving area. Now I will turn back to David, who will share some further resources to help you make effective climate-related financial disclosures.
Great. Thanks, Nadine. So just to touch on a few resources for those who really want to dive in and learn more. First, I'll touch on the documents that we mentioned earlier in the webinar, just to summarize. First, the TCFD Implementation Guide, which the CDSB and ourselves produced and published earlier this year. This guide is really a practical how-to guide for how companies can make disclosures in accordance with the TCFD's recommendations. And the guide features a set of mock disclosures across 3 different companies and all 4 of the TCFD's recommended disclosure areas that include annotations that walk you through step by step on how to craft TCFD accordant disclosures to meet investor needs for useful, comparable information. To follow up to that, we published the TCFD Good Practice Handbook, which we have discussed in this webinar, really in response to a desire from the market for additional examples of what good practice disclosure looks like. And in this case, as we described, we pulled examples from across the G20 from annual reports to provide additional examples to help companies who are looking to get started in making their TCFD accordant disclosures or to improve their existing disclosures. Additionally, I want to highlight the TCFD Knowledge Hub. This is a fantastic resource that includes a huge amount of resources that are available in each of the TCFD's disclosure areas to help you with your reporting. Resources include our implementation guide and good practice handbook, as well as resources organized under each of the TCFD's recommendations. The Hub is powered by CDSB and is an online aggregator for publicly available resources, events, and case studies relating to the TCFD. There are also e-learning courses on making climate-related financial disclosures that were developed by the CDSB, and they launched earlier this month. So I'd really encourage you to go to the TCFD Knowledge Hub if you would like to learn more, as it really provides just a fantastic database for folks who want to learn more and improve or start making TCFD accordant disclosure. And finally, I just wanted to remind folks or draw your attention to the Corporate Reporting Dialogue's Better Alignment Project, the report from which was launched last month during Climate Week in New York. This will be of particular interest for folks joining this webinar, as the report really focused on each of the CRD member organizations mapping their frameworks to the TCFD's recommendations. And that includes the CDSB, IIRC, SASB, CDP, and GRI. And you can find as part of the report, each of the frameworks, CDP, SASB, and GRI, mapped our metrics to the TCFD's 50 illustrative example metrics in the implementation annex of their report. So it's really a great resource and shows how the 5 leading framework and standard setters, including SASB and CDSB, are collectively aligned to the TCFD's principles for effective disclosures, as well as the recommended disclosures. And it provides a mapping of how we fit together in the context of climate. So really a wealth of resources available, and we encourage you to take advantage of them. And with that, I want to thank everyone for joining, and I believe we are ready to answer any questions we may have received from the audience. So we'll turn it back to you, Leslie.
Thank you very much, Nadine and David, for that really informative information presentation. Lots of information has been coming through as well, so we do have some questions. And as promised at the start of the webinar, we will share the results from the poll. So while I'm going through the Q&A, if anyone does want to submit more questions, you can do so using the question function on the right-hand side. But firstly, I will share the results from the poll this morning. So the question that we asked was, is your organization currently implementing the TCFD recommendations in the mainstream report? So we've had 22% of our audience say yes, 51% say no, and 28% saying they intend to do so. So definitely some interesting results. I'm hoping today's presentation and indeed the TCFD handbook will help those who said no with more useful tools and enable them on their journey. David or Nadine, would you like to comment on the results?
Maybe I can jump in first and just echo what you said, in that really a lot of what we heard from the market, both CDSB and SASB, was in companies seeking to implement the TCFD's recommendations in their mainstream report, there's really a desire for resources to help them do so. And the number one resource we were asked for was what were examples of what good disclosure looks like. And so we really do hope that these resources can be helpful in that regard, and helping those companies that have indicated that they will start reporting in the next 3 years, or for companies who aren't currently considering, to take a look at what it might entail to begin producing reports that include this information. Of course, we're always interested to understand from the market what additional resources we can provide to help them along in their reporting journey, and so certainly would welcome any feedback from folks about where they're running into pain points or where there are particular hurdles that they're struggling to overcome, and certainly would look for ways that SASB and CDSB can be helpful. Nadine, any thoughts on your end?
I think it's promising that that almost 1/3 of the participants on the webinar are intending to do so in the next 3 years. So hopefully the twin tools that we have provided, as well as the wealth of resources on the TCF Knowledge Hub, will help you in your journey to make your effective TCFD disclosures in your mainstream report. And we'd be very interested in any feedback on either the implementation guide or the handbook as you go along. So please keep us posted.
Thank you very much. That brings us to the Q&A. So we have had some questions come through, as I mentioned. So let's start with the first one, which directly relates to some of the content within the guide. So with the EDF example, you spoke about their approach to regulatory changes in France. What are the important regulatory developments happening in the UK, Europe, and the US that organizations should be aware of?
Nadine, would you like to go first?
So sure. The first thing that I'd like to say is that the UK released its green finance strategy in July, and they included that there's an expectation that all listed companies and asset owners in the UK should make their disclosures in line with the TCFD by 2022. So that's only so within 3 years, all listed companies and asset owners we expect will be making TCFD aligned financial disclosures. We also know that that this has been an area of strong interest by the European Commission, and they have produce climate-related guidance in the context of the EU Non-Financial Reporting Directive, and we also anticipate that the EU Non-Financial Reporting Directive will be opened up in the coming sessions of the European Commission and Parliament. So there may be further developments there as well. David, would you like to touch on some of the developments in the US?
Sure. Yeah. So I'll touch on just a few things that are happening here in North America. And on the U.S. side, there are a number of initiatives coming out of the Financial Services Committee and the Democratic-controlled House of Representatives that relate to both ESG disclosure broadly, as well as specifically climate-related disclosure. And so a number of these acts are being initiated in that committee. And two that are particularly relevant for this subject matter include the ESG Disclosure Simplification Act and the Climate Risk Disclosure Act. So things to keep an eye on here in the US. And in Canada, recently, the Canadian Securities Administrators published a staff notice related to the reporting of climate-related risks for boards and senior management. And really the intent there was to support the evaluation and disclosure of climate-related risks. So that document references the TCFD directly, so a strong indicator of the focus on TCFD in that particular region.
Thank you very much. The next question is around scenario analysis and the examples presented today. Do you have any examples around good practice in scenario analysis? And if so, what companies should we be looking at?
Nadine, would you like to start?
Sure. So one of the examples that that we include in the guide is Unilever, and one of the reasons that we find that a particularly good practice example is they state clearly the two scenarios that they have used to assess the resilience of their organizational strategy to a changing climate in different future states. They state clearly what the assumptions are, so that therefore it's easier to interpret what those disclosures mean. And then finally, they do what a lot of the disclosures on strategy C and the TCFD don't do, is they state how resilient their organizational strategy is, and then they conclude that they don't need to make significant changes or any changes to their organizational strategy in light of their findings. So that's a good one to look at. There's a couple of others as well in the handbook.
Excellent. Thank you, Nadine. And the links for the handbook are included in the presentation, and it can be downloaded directly both from CDSB's website and also SASB's website. So do head to our websites to download that. Once we wrap up, we will also distribute the slides and a recording of this presentation, so you will have all of those materials. We have time for a couple more questions. Thank you so much to everyone who have submitted them. We do have quite a lot of them to get through, so unfortunately I don't think we will be able to answer everyone's, but we will collate all of these questions and look at getting those answers out to you. So a few of the questions have been touching on the difference between the mainstream report and the sustainability report, and I think the main question that's arising is, why shouldn't you make these disclosures in the sustainability report versus the mainstream report?
Maybe I can touch on that first, and Nadine, of course, would welcome your comments, but really would point to the recent TCFD's status report, which really dives into some of the issues around both looking at the reporter perspective as well as the user perspective on the existing disclosures that are being made by companies. And one of it was the number one finding for users of this information was the desire for greater connectivity between the company's performance on climate-related factors and financial implications of those risk exposures of the company's strategy and so on. And so really the annual report is the ideal location, as the TCFD recommends in their original recommendations report, to provide that really holistic view for a user of this information regarding that key connectivity between how a company is managing its climate-related risk and how that connects through to financial impacts. Additionally, it really helps provide context, as we saw in the example from Danone, about how climate-related risk fits into all the other risks that the company is managing and for which it's developing in its strategy. So it really provides that holistic understanding of the company's strategy and where climate fits into that overall strategy. So Nadine, of course, would welcome your comments as well.
Thank you, David. I echo everything that you said, and just to also add that including it in the annual report allows for greater robustness of the information. So there's a process and a level of rigor to including things in the annual report and having them signed off. So it gives the users confidence in the robustness of the data and information. And we've also seen in the second status report that the disclosures are on the increase both within sustainability reports, in separate climate-related financial disclosure reports, and in the mainstream report. And so eventually over time the TCFD has the implementation path, and we expect to see that over time more and more companies will feel comfortable with putting this in their annual report. Thank you.
Thank you very much. And that actually leads nicely into a question that we've had on future outlook. So specifically, what is the outlook for the task force itself? So as we move forward and as we see, higher quality reporting, will we see recommendations 2.0, for example, or where is the task force moving in the future?
Nadine, would you like to go ahead?
Sure. We obviously we're not members of the of the task force, so it wouldn't be appropriate for us to speak. But we do understand that they are looking at providing some further guidance and support in particular areas, and that is currently under planned development right now. So I think it's just really to watch this space, because I suspect there will be more guidance coming out. I don't know, David, if you have anything to add on that.
Yeah, just to touch on, they did provide some directionality around the areas that they're really looking at in their 2019 status report. So I would encourage folks to look at that report. They touch on some desires from the market for additional guidance around scenario analysis and other pieces like that. So they did provide some directionality around areas that might benefit from additional focus in their status report.
Excellent, thank you. And we'll just take one final question regarding the companies that you and the organisations that you assessed for the handbook. Were there any sectors that you saw that were predominantly reporting, in line with the TCFD? Were there sectors that you felt were really lagging behind? And indeed, what was the process that you went through to analyse the reports?
Shall I start? We looked
Sure.
at a number of different annual reports, both and also based on our engagement from the two organizations with the market and our experience in reading reports. So we cast the net much more widely than the 19 reports that were included in the Good Practices Handbook. And one of the things that we found particularly interesting is that, and I think this is also reflected in the second status report, that financial sector companies are also, so financial institutions are being particularly strong on their disclosures, as evidenced by the second status report.
Yeah, and just to touch on that, we really tried to intentionally pull examples of good practices across different industry groups, really to show how the TCFD's recommendations can be implemented in an effective way, even outside of the financial services sector. And so that's one of the reasons we really invested time in trying to read a wide diversity of reports, and specifically to include a number of different examples across the G20, different jurisdictions, different company sizes, different industries, really to provide that mix and diversity of examples to help we reach the widest audience and provide examples that any given company can find something that's useful for them. So it was an interesting exercise, and we hope that everyone on the call that reads it benefits from that work as well.
Thank you very much. And that does bring today's webinar to a close. We thank you all for